Share repurchase is the reacquisition by a company of its own shares. It represents a more flexible way of returning money to shareholders. In most countries, a corporation can repurchase its own stock by distributing cash to existing shareholders in exchange for a fraction of the company's outstanding equity. That is, cash is exchanged for a reduction in the number of shares outstanding. The company either retires the repurchased shares or keeps them as treasury stock, available for reissuance. Under U.S. corporate law, there are 6 primary methods of stock repurchase: open market, private negotiations, repurchase put rights, 2 variants of self-tender repurchase, and accelerate repurchases. More than 95% of the buyback programs worldwide are through an open market method, whereby the company announces the buyback program and then repurchases shares in the open market. In the late 20th and the early 21st century, there was a sharp rise in the volume of share repurchases in the United States. $5 billion United States dollars in 1980 rose to $349 billion United States dollars in 2005. Large share repurchases started later in Europe than in the United States, but are nowadays a common practice around the world. It is relatively easy for insiders to capture insider trading-like gains through the use of open market repurchases. Such transactions are legal and generally encouraged by regulators through safe harbors against insider trading liability. U.S. Securities and Exchange Commission Rule 10b-18 sets requirements for stock repurchase in the United States. Companies typically have 2 uses for profits. Firstly, some part of profits can be distributed to shareholders in the form of dividends or stock repurchases. The remainder of profits are retained earnings, kept inside the company and used for investing in the future of the company. If profitable ventures for reinvestment of retained earnings can be identified. However, sometimes companies may find that some or all of their retained earnings cannot be reinvested to produce acceptable returns. Share repurchases are an alternative to dividends. When a company repurchases its own shares, it reduces the number of shares held by the public. The reduction of the float, or publicly traded shares, means that even if profits remain the same, the earnings per share increase. Repurchasing shares when a company's share price is undervalued benefits non-selling shareholders and extracts value from shareholders who sell. There is strong evidence that companies are able to profitably repurchase shares when the company is widely held by retail investors who are unsophisticated and more likely to sell their shares to the company when those shares are undervalued. By contrast, when the company is held primarily by insiders and institutional investors who are more sophisticated, it is harder for companies to profitably repurchase shares. Companies can also more readily repurchase shares at a profit when the stock is liquidly traded and the company's activity is less likely to move the share price. Financial markets are unable to accurately gauge the meaning of repurchase announcements, because companies will often announce repurchases and then fail to complete them. Repurchase completion rates increased after companies were required to retroactively disclose their repurchase activity, the result of an effort to reduce the perceived or potential exploitation of public investors. Normally, investors have more of an adverse reaction to dividend cuts than postponing or even abandoning the share buyback program. So, rather than pay out larger dividends during periods of excess profitability than having to reduce them during leaner times, companies prefer to pay out a conservative portion of their earnings, perhaps half, with the aim of maintaining an acceptable level of dividend cover. Some evidence of this phenomenon for American firms is provided by Alok Bhargava, who found that higher dividend payments lower share repurchases, though the converse is not true. Aside from paying out free cash flow, repurchases may also be used to signal and/or take advantage of undervaluation. If a firm's manager believes their firm's stock is currently trading below its intrinsic value, they may consider repurchases. An open market repurchase, whereby no premium is paid on top of current market price, offers a potentially profitable investment for the manager. That is, they may repurchase the currently undervalued shares, wait for the market to correct the undervaluation whereby prices increase to the intrinsic value of the equity, and reissue them at a profit. Alternatively, they may undertake a fixed price tender offer, whereby a premium is often offered over current market price. This sends a strong signal to the market that they believe that the firm's equity is undervalued, which is proven by their willingness to pay above market price to repurchase the shares. However, scholars also suggest that repurchases sometimes